The Rebel Capitalist Show. All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Education Series for part number 2 of how you can build your own dragon portfolio. His name is Patrick Ceresna. Patrick, welcome back to the Rebel Capitalist Show.
Thanks a lot, George. Thanks for having me, bud.
Okay, now last week we went over how to go long volatility. People have read Chris Cole's paper. They see the dragon portfolio. They're like, okay, this is awesome. We've got gold, got bonds, got some equities. We get that. But going long volatility, that's kind of a mystery. How do we do that? So we addressed that briefly last week. But now we're going to go over how to do trend following for commodities. And that's a really big component of this. And I just want to let people know that at the end of this video, we're going to talk about a live presentation we're going to do. We're going to go right over your shoulder. So you're going to go into the market live this Friday and actually build a dragon portfolio. So we're going to give people the opportunity. We've been going back and forth on this. We finally finalized everything with your team. So people are going to have the opportunity to go into the market with you live as you build the entire portfolio. So going long volatility, trend following with commodities, gold, equities, bonds, the whole thing.
That's right. And so it's going to be a lot of fun. You're going to join me and we're going to have a great time putting it all together. But today, though, we wanted to just focus on that last component, right, George? Which is we wanted the idea of trend following. And the one thing that we're going to touch on as well in that live session is I only offered your listeners one of the ways of going long volatility when we talked about that back spread. But there are other ways of generally being long volatility, and we'll touch on those in the new live session. So that was just one of the strategies.
Yeah, and these educational series we're doing right now, we've only got a half hour or so it's just a broad overview.
Exactly.
But Friday, we're going to really take a deep dive and figure out, click by click, how the average Joe and Jane can build this dragon portfolio for themselves. And we're going to give everyone the opportunity to join. We'll discuss it further at the end of this video. I want to point out, though, for Rebel Capitalist Pro members, it's going to be free of charge. But again, we'll talk about that at the end of the video.
All right, so let's get to it then. So let's jump into commodity trend following here, George. And so what I wanted to just start off and touching on here is that the standard market cycle is let's go back to the entire premise of trend following in the first place. And it's this idea that it's the cycle that we've been in is been driven by fundamental growth, but these cycles end with these massive leveraged economies with huge amounts of debt. And they tend to go through a big secular change, usually through a big wave of inflation or deflation that drives that big secular change, as Chris Cole was referencing as the wings of the hawk. And so the one of the reasons why commodity trend following is such an important component of this is, well, if you think about what drives deflation or what drives inflation, then one of the great places where that is expressed in the changes in the price of commodities, right? And so when oil's collapsing, it's a deflationary impulse, and if let's say oil is rallying or all commodities are rallying, it's very inflationary. And so by adding a component that tracks those trends of commodities builds an inherent hedge into the portfolio. And so this is where we want to talk about commodity trend following and some of the really interesting observations to make. So obviously, like I was referencing there, deflationary cycles impact commodity pricing, and therefore being invested into commodity trend behaves as that critical hedge. And that's one of those key assets within that mix to building this whole portfolio. And so what is commodity trend following? And this is where we want to touch on. It's the idea of buying when the prices are up and selling when they're down, and expecting these movements to continue. Now, this is actually psychologically quite counterintuitive because every bone in our body wants to buy low, sell high. In other words, I see the price low, that means I buy. And I see the price high, I want to sell and take advantage of it when it comes down. And that is
That's what I preach nonstop on my channel.
exactly. Like it because it's intuitively what we as investors do. But trend following is you have to untrain that intuition and actually create a portfolio that is actually buying when the trend is up and selling when the trend is down. Now, that in itself as a standalone strategy may not be the most profitable over very short-term cycles. But when inflation or deflation begins these extraordinary trend moves, these commodities can trend for extended periods of time, and this forces you to be invested in the prevailing trend and subsequently therefore it behaves as a hedge to your balanced portfolio. Right? And so we have to find a technical approach for us, forcing us to stay with the prevailing trends. And so I want to share with all of your listeners some really neat ways that we can do this and what to do it on. And so what are the complexities? In trend following, there's no easy way for retail investors to access because the majority of commodities, beyond physically buying them and storing them in your garage, beyond that, you have to access the futures market. And the futures market is a whole layer of new complexity. Margins, margin calls, how much exposure do I have? How do I size my trades? Where do I get access to these futures? There are definitely some of your listeners that are sophisticated enough to do that. But let's say the majority of retail investors, this is a whole next level up. This is something that normally is intimidating for a beginner. The second thing that we touched upon last week as well is that most commodities trade in contango, which means that they have a negative carry. And so even if you do access these futures markets, they all have each futures contract has an expiration. And when you go to close one and reopen a new one, you are basically at that moment usually paying a carry cost that therefore is a tax on you staying with a commodity over time. Now, this is also built into ETFs, right? Because the ETFs own the futures and therefore it's being priced in to the future, into the futures contract. And so this is something we have to deal with. Now, generally though, it ends up working out because in trend following, you end up being short about the same amount of time that you're being long. And so while you're paying a negative carry while you're long, you also are going to earn the carry when you're short. And so actually it tends to start working itself out. Long as you're willing to follow the trend and be long and short, it starts to work out over time. And now there are many commodity-based ETFs out there, but many of them lack liquidity and often will have all sorts of little tracking errors and what's the real basket. There's all sorts of things. And so this is where most retail traders say, nah, I'll do everything else in the Dragon portfolio, but I'm going to skip this commodity trend thing because it seems too complex. As well, a lot of commodity trend following CTAs need a certain amount of capital, so it's not easy to access as a small fund for most traders. You need there's usually a barrier of entry for higher net worth individuals to be able to do commodity trend following. So how do we overcome this? How does a retail investor go through this whole process of building one of these? And so let's do a do-it-yourself for retail traders commodity trend following method. So the first thing that we want to touch on is the idea of oil and tracking oil. Now, you may have heard on Macro Voices, Eric and I having extended conversations about this last few months where oil was trading at contango and all the USO traders were suffering huge negative carry being built into the ETF. And now the ETF or ETN had to turn around and stagger their futures contracts to reduce their impact that they had. And so there was a hiccup in the ETF product in this cycle. But when you step back and reflect on oil as a commodity trend following product, there more often than not, crude oil actually trades in backwardation, not contango, which actually means that out of all of the commodities, over time, it actually has the least carry. In fact, sometimes you may even earn a carry on crude oil. And so therefore, even though majority of commodities suffer from that contango and that negative carry, oil often does not. And
it's, just so I'm clear, Patrick, if it's in backwardation, you're getting a positive carry, aren't you?
yes, on when you're long, but then negative carry when you're short. So it's to the opposite. And now the USO as an ETF turned around and actually diversified their portfolio amongst even, I think, a 12 expiration. So they went forward and really made sure that they were balanced. And therefore, you're on multiple levels of the curve that smooths out the whole issue over time.
The problem with that is just not going to track the spot prices accurately, correct?
Right, but if you think about what you're trying to achieve with commodity trend following, is you want when let's say there's a huge currency debasement and crude oil therefore skyrockets in its price, the USO is going to be able to trend follow that relatively well, right? So you're not going to, if you were trying to trade oil per se for the technical reason of what you believe oil will do, the USO might not be the greatest product. But if you want a trend following vehicle that is going to be an inflation or deflation hedge, USO still will do the job. Now, why though as well oil? Oil is the largest market by a long shot. I remember seeing this visual capitalist image where they took every single basic material and put it into a bubble compared to the size of the oil market. And the oil market was essentially bigger than all of the other commodity complex combined.
Yeah.
Oil is the single biggest inflationary, deflationary driver in an economy just because of its sheer size. And so if you were going to choose just one commodity to trend follow, trend following oil makes the most sense.
Okay.
Now,
and I want to be clear just for one moment, because I've been very critical of USO on
yes.
my videos. I say, don't buy USO. You don't know what you're doing. If you look at it from 2015 to today, it's guaranteed to lose money. But I want to clarify now that we're able to really get into the weeds here. If it's in contango and you just go long and you say, oh, I'm just going to buy it and put it in my portfolio, and it stays in contango, you are guaranteed to lose money because of the negative carry. Yeah. Unless it spikes up really quick and you sell and get lucky. But if you're putting it in your portfolio for 10 years and it stays in contango, but if it's in backwardation, and then you know how to do it smart with these trend following strategies, which I assume have a stop loss. And then as they go up, you just move the stop up. I'll let you get into that in a moment.
Yeah.
Then it can be a proper tool. So it's just like Advil. If you take 2 of them, it can have some benefits, but you take 10 of them and do it the wrong way, and you're gonna kill yourself.
But it's also about what it is that you want the product to do in your balanced portfolio.
Right.
If you're trying to go long oil because you thought it was cheap when it was down at 20. The USO did not allow you to properly participate in what you perceive to be the rebound in oil off of its low. But if you're going short the USO or long the USO based upon commodity trend driven by these long secular changes, whatever negative carry you have on the one side, you'll have a positive carry on the other. It's about the hedge it provides your portfolio as a trend following thing. And so it's all about what you want the product to do. Now, unfortunately, this is the consequence that we have to, or the trade-off, because as retail investors, otherwise you have to go in the futures market, but you're still dealing with term structure in the futures market as well. I mean, this is just something, if we want to be in the commodity space, we have to deal with. And but there are other ETF baskets. I listed here 4 other ones, and each one of them has its own characteristics, but they will all suffer contango. Like, I mean, when you're holding baskets of grains and copper and all sorts of other futures contracts inside each of these baskets, each one of them are still holding a basket of futures contracts, and those futures contracts are trading in contango, and they will all suffer while you're long the commodity. They will suffer a carry, but when you're short the commodity, you'll earn the carry. And
Patrick,
so,
is it possible to do the commodity trend with the producers?
yes, we'll talk about this actually next, which is what I wanted to just show is I overlaid here. Well, what if we just use the actual companies versus the commodities, right? So the first thing I wanted to present is if you actually wanted to participate with the commodities, you can track one of those. But here, what I chose to do was overlay this is the XME is the symbol, which is the metals and minings ETF.
Okay.
And I overlaid that versus copper and orange. And what you can more or less see is that the volatility of the metals and mining index was actually greater. But it generally is trending the same. When the one is trending down, the other, and so there's going to be a correlation. And so a lot of retail investors could also choose to implement a trend following technique on an underlying equity.
Yeah.
And now this in itself is fine, but you do also want to recognize if you're going long short equity, you will have a negative carry when you're short based upon whether it's the loan value or dividends. And so if you're short a commodity stock and it pays, let's say, a 3% dividend, you have a negative carry as well. All right. And so you just have to find something that you feel will give you the participation. Now, and again, I'll just say the same thing I said before, which is, well, you'll have a negative carry when you are, let's say, long, but you have a positive carry when you're short, or vice versa. You're going to always have a trade-off, but over time, because you're always flipping from long to short, it tends to work itself out over time. Right? But it is okay. And a lot of retail investors will understand this better. I know where to find the stocks and the ETF, and it's easier for them to express the trade this way.
Patrick, when you say over time, are you talking about over time meaning a year, 5 years, 10 years? How would you define it?
Well, definitely. If you think about what Chris Cole, when he's looking at the Dragon portfolio, he's talking about building a portfolio that's being invested over 100 years. Like you're staying in commodity trend over the long term. And so there are going to be extended periods where you are long a trend or short a trend. And the point I'm making is over a long period of time, you're probably going to be short as often as you're long. Probably long a little bit more often than you're short, but then point being that you're going to have a negative carry one time, a positive carry the other.
I mean, I'm just looking at these trends in copper, and you can see I'm going to go from 2009 to 2000. That's 2 years, and we kind of go another, call it 5 years.
Yeah.
And so, yeah, this isn't something where you switch back and forth every month.
You're talking about maybe once or twice a year there being a meaningful change in trend that would make you flip. So you're buying and holding for extended periods of time. There's no day trading involved with commodity trend following, right? You're going to have these extended cycles, and another obstacle commonly that retail investors run into is the fact that they're just intimidated by the idea of going short in the first place. Everyone wants to generally be buying something, going long, and so when you tell someone to go short something, that's now as well a level of sophistication that you need to understand what you're doing, and even just the psychological thing of actually acting upon short selling something and being comfortable holding it for an extended period of time, right? And so how do you overcome that obstacle of the fact that there is even retail investors that don't want to be generally short. And one of the interesting observations I'd make is about currency correlation. And what's interesting is that there's a strong intermarket correlation between commodities and currencies. And so generally you have what generally drives commodities uptrends is a period of U.S. dollar weakness. Equally, and to the opposite, generally commodities are very weak during a U.S. dollar bull market. That's a very basic foundation of intermarket relationships. And eventually, when the dollar loses its world reserve currency status, maybe this dynamic might change, but that doesn't seem to be an imminent threat to the foreseeable short-term future, and therefore this relationship would stay true. And so, an interesting observation to make, and so here I overlaid the DJP, which was one of those commodity ETFs, with that of the euro. And what you can observe here is that generally, because the euro is the single biggest currency pair that crosses against the US dollar, and it's a 57% weighting in the DXY index, in the dollar index basket. Mm-hmm. So we know that commodities move opposite direction to the US dollar, then they will actually have correlation to the euro.
Right.
And
maybe more like the Aussie dollar or something.
Right. And so what one of the ways that one can turn around and get a similar style portfolio hedge is actually by their currency positioning inside their portfolio. And so if you generally anticipate the US dollar to be weak and commodities to be strong, then you actually can very much achieve much of that same thing by simply diversifying your holdings out of US dollars and hold many of your other assets settled in other currencies. And so you can actually get now. You have to volatility adjust this because commodities are way more volatile than currency, and their implieds and historical volatilities are much higher, and so you can't parrot the same amount saying, well, if I'm supposed to have an allocation of 20% to commodity trend, then it's enough for me to go 20% in currency trend. No, you'd actually probably have to take a much larger weighting in currency trend in order to offset or to try to create the same influence that you would have. But this is immediately makes it more accessible because there are a lot of traders that would be able to access Forex trading accounts and be able to put on currency trend moves and simply just change the amount of US dollars you have in your portfolio will often give you a very similar influence to what commodity trending is trying to achieve in the overall balanced portfolio. And so these are different choices. You can either A, take an ETF, or 2, you can trade the underlying commodity stocks, or 3, you can look at the fact that the currencies are correlated with commodities, and therefore you can express a lot of that trend following through currency. And so everyone can pick their poison. You can. The point is that you can turn around and trend follow with all of these in one degree or another. And so the question really is that which one do you want to do, and how do you size it? And this is one of the things me and you will do together, George, when we do that Friday session. Is we're gonna come up with what are we gonna trend follow, and let's size the trade. How much of it are we going to put into the portfolio? That's one of those fun puzzle pieces that we'll try to do when we're putting together our own Dragon portfolio for retail investors.
For sure. Yeah, and I think that's something that most people totally ignore. I mean, I think people get 99% fixated on, well, is it going up or down? And they just totally ignore money management, the structure of their portfolio, and the emotional state and getting ego and emotion out of the equation, just making analytical decisions. And I would argue that the things they ignore are probably more important than the things that they place 99% of their attention on.
Oh, I agree. And so, what we just figured out is that we can use any number of these different products to achieve a lot of the same outcomes. And it's just about each retail investor has to figure out what they have access to, what they're comfortable with, and how do they get something that is giving them that exposure that they're looking for to create this dragon portfolio. So now, how do you actually though follow the trend? And this is where I just want to leave the next stage. And so now, as a technical analyst, the one thing I've learned over time is that it's very actually hard to find a lot of technical analysts that look at things the same way. Everyone has a different way to skin a cat. Like there's different, and you'll have some commodity trend following guy come onto Macro Voices and say, this is the way we do, and we've created a sophisticated model. And then you have another person say, no, we do it this way. And I actually don't think that one of them is wrong and the other is right. As long as you have a system from which you're trying to follow the trend, there are a number of different ways to achieve it. And so what I wanted to say is, like, there are all sorts of more sophisticated and complex ways of doing it, but I wanted to just introduce two straightforward ways that your listeners can, in a very basic way, stay on the right side of the trend.
Great.
And so the key is you want to have very little room for discretion. It's really black and white. Either it's trending up or it's trending down, and you need to stay with that trend. Now, I wanted to just start off with a very basic way that almost all junior technical analysts can do is putting on just a moving average. Moving average is the single most commonly utilized trend following technique. But using the moving average crossover technique is actually very important for smoothing out noise, which is that you're looking for when let's say in this situation, I have the DJP, which is the ETF for commodity trend following. I particularly chose 2007 through 2011 because I wanted to actually catch an uptrend as well as a downtrend, because recently commodities have only been downtrending, and I wanted to make sure I went to a period in time where we can see what happens in a trend following technique during an uptrend as well as a downtrend. So that's why I went back in time here. But if you notice here, we're going from 2007 to 2011, and there were, six signals to buy or sell. And it's not really, remember, when you go into a period like 2010 where it just chops up and down and then up and down, well, that's fine, because that part of your portfolio is not meant to make you money. That asset allocation to trend following is supposed to be there when we have those huge inflationary and deflationary impulses that drive commodity trend. And so because of this, you're going to get signals to get in and out on multiple occasions. But if you notice, when a major uptrend is occurring or a major downtrend is occurring, it's forcing you to stay long or short through the entire trend. Now, this is a weekly chart. And so we're zooming out a little bit on a bigger trend. Now, this is something that almost every one of your listeners can access. And this is why I wanted to just say this is the most basic way someone can just follow the primary trends. You do not want to use daily charts because there's just too much noise. Like in the end, you don't want something that's going to go in and out and in and out, and you have to micromanage it on an ongoing basis. You want something that will keep you in for those 9-month and 1 year or 2 year cycles. Now, there's a second technique which I really like a lot, which is when there's a number of charting techniques that allow you to remove time and only focus on price as a variable. Now, probably one of the most common ways is point and figure charting, but I wanted to follow another one, which is called Renko Charts. Renko Charts and point and figure charting have the similar characteristic in that it's focused on price movement. and eliminates time as a variable, which is that price has to change a certain amount for the chart to print the next moving along on the chart to the next variable. Okay. And so by doing this, what it's doing is it's forcing when those periods when the stocks are doing nothing and just chopping and staying within a range, it forces all of that noise to be compressed. And it removes it, so you have very clean stepping charts. And so what in this scenario, a Renko chart prints a new brick when the price moves a specific amount. Now, that specific amount can be set to a price amount, but it also can be set to an average true range. There's a number of different settings within the charting system, and it always puts a new brick in a 45-degree angle up or down. So it creates a chart that looks incredibly clean. It creates a chart that removes a lot of the noise. And what you can observe here is that notice between 2008 and 2009, look how long of a sequence that is versus the period between 2009 and 10. Right? What happens is that it's not based upon time. In order for the next one of these little bricks to be printed, the price has to change a certain amount. And if it doesn't, I mean, in theory, you could have it like, look at that distance between 2012 and 13. It was even that much more narrow. And when the commodities are not trending, then this is not printing more bricks. And what this forces you to do is that it only shows you when the price is changing and a trend is underway. And when this price is not changing, then then this chart is not changing.
And is the blue line a moving average?
And so what I simply did there for clarity was I added the moving average. But there are a number of different techniques, and we could talk about it more during the live session we do as to what you can use as buy or sell signals in something. But what this generally does is it forces you to stay in trend, because it becomes incredibly clean where the trends are, because it doesn't add that variable of time, which tends to make charts look very choppy.
Yeah.
And when you're trying to create a chart that is always forcing you to stay in a trend, then whether you use point and figure, which I didn't demonstrate, or whether you use Renko, they're very interesting charting techniques that force only the trend to emerge on the chart. And it's just something I thought that all of your listeners may enjoy.
Yeah, I just want to make sure everyone's on the same page here and they're following this, Patrick. I want everyone to take a look at the distance on the chart between 2008 and 2009, and then look at the distance between 2012 and 2013. So they're just literally printing a lot fewer blocks, 2012 to 2013, because there wasn't many price moves. Right. And so, yeah, very cool.
So when commodities aren't trending, the chart isn't doing all this noisy stuff. Mm-hmm. And when a major trend gets underway, then it's very well advertising that there's a major price change underway and you need to pay attention. And so that it's a great way of forcing you to always stay in the direction of these major trends. And so these are just two techniques of a whole array. And I'm sure there's going to be a number of your listeners that are going to type in on the chat, well, I prefer this, or I do it this way. And that's okay, because you know what? Long as you have a technique, you just need something that forces you to stay in the direction of the primary trend, and you choose a product that will achieve what it is that it's meant to do, which is that during periods of sustained inflation, commodities rise. And during a period of sustained deflation, commodities are falling. And by having that as a component of your diversified portfolio, it behaves as a valuable hedge to ensuring that your portfolio doesn't experience this crazy volatility and protects your general portfolio during those wings of the hawk scenarios that Chris Cole talks about. And so this is some of the different ways of doing it. And you know, I don't know whether there's, again, if one of your members said, I'm just going to use a moving average crossover and I'm going to follow it on a commodity stock, I would say, that's okay. Another person's going to say, I'm just going to stick with futures contracts and I'm going to use the Renko charts. I'd say that's okay too. You just need to find some way of identifying the predominant trend and have some product that will trend during those inflationary and deflationary impulses. Currency can achieve the job, commodities achieve the job, and you want to add them into your portfolio and build this that way.
Yeah. Hey, Patrick, one question. Why did you use the 10-day moving average and the 20-day moving average?
It was 10 and 20 week there. Not in particular, simply that they're very commonly used. What I wanted to do was just demonstrate one of the most commonly utilized trend following techniques in technical analysis, and that's just a moving average crossover, a 10 and a 20 period moving average. And you could see that over a period of 4 or 5 years, it only gave like 6 signals on the weekly charts, right? It's not where you're going to 1 month get in and 1 month later get out. It's going to force you to stay in these trends for extended periods of time, and it's going to do what it's meant to do in that balanced portfolio.
Mm-hmm. Got it.
All right. And that's all I've got for you, George.
All right. So Friday, can you walk us through what you're going to be doing Friday? I mean, are you going to be going into your interactive broker account like we did last time?
Absolutely. What we're going to do is we'll take, let's say, a hypothetical $100,000 account, and we'll just build it. I'm actually going to demonstrate the use of a straddle as well as a way of going long volatility. We'll talk about different ways of going long bond volatility as well. We're going to make sure we have our trend following component built in there. We'll obviously put in the exposures to equities and to bonds and to gold. We're going to get all of that in there, and we'll just build a retail friendly Dragon portfolio.
Right. So people can just follow you. You're actually clicking on the buy button and everything. It's subtracting from your account, and you're getting
they can see how many shares we're going to buy of what, and they can follow it along and see how we put one of these together.
Great. Are we going to do a Q&A at the end?
For sure. That was so good last time when we did that. It was fun interacting with everyone. So looking forward to it.
Yeah, and the biggest question of all, it's on everyone's mind, Patrick, is our hold music going to be Guns N' Roses?
Yes, absolutely. Welcome to the jungle.
That's right. Okay, buddy. For anyone who is interested in joining Patrick and I this Friday, we'll put a link in the description below. If you are a Rebel Capitalist Pro member, we're going to take a separate link so you can access it free. We're going to put it in the Rebel Capitalist Pro forum, so make sure you look for that. And Patrick, as always, I appreciate your time, and I can't wait to see you Friday.
Thanks, George. Looking forward to it. See everyone in there.
All right.